I need to give you a warning that most people in my position would never give. I am about to tell you to sell certain AI stocks, which might seem strange coming from someone who has spent over 30 years building AI infrastructure and who benefits enormously when people invest in artificial intelligence. My company sells the picks and shovels of the AI gold rush. When investors pour money into AI companies, many of those companies buy our chips. You might think I would want every AI stock to keep rising forever, but I have watched too many investors get destroyed by hype cycles to stay silent any longer. And what I am seeing in certain corners of the AI market right now reminds me of patterns that have preceded every major technology crash I have lived through. I was there during the dot-com boom and bust. I watched companies with no revenue and no business model achieve billion-dollar valuations. I watched investors convince themselves that traditional metrics no longer applied, that we were in a new era where the old rules had been suspended. I watched the crash wipe out trillions of dollars in wealth and destroy the financial lives of countless people who thought they were participating in a sure thing. I survived that crash because I was building a real business with real products and real customers. Many others were not so fortunate. Not all AI investments are created equal. Some AI companies are building real products, generating real revenue, creating real value for customers who pay real money because the products solve real problems. Those companies deserve the valuations they command, and some deserve even higher valuations than they currently have. The best AI companies are building durable competitive advantages that will compound for decades. But other AI companies are riding pure hype. They have attached the letters AI to their name or their pitch deck, and they are benefiting from investor enthusiasm without having the fundamentals to justify their stock prices. These are the companies that will collapse when the music stops. When the correction comes, and it always comes, the companies with real businesses will survive and eventually thrive. The companies built on hype will collapse. And the investors who cannot tell the difference will lose fortunes they spent years accumulating. I do not want that to happen to you. So today I am going to tell you about 5 categories of overhyped AI stocks that I believe you should get out of before the first quarter ends. Let me be clear about what I mean by overhyped. I am not saying these companies are frauds. Most of them are legitimate businesses run by well-intentioned people. I am not saying their technology does not work. In many cases, the technology is genuinely impressive. What I am saying is that their stock prices have become disconnected from any reasonable assessment of their future cash flows. They are priced for perfection in a world where perfection never happens. They are priced for growth that would require everything to go right for years or decades. And when reality inevitably falls short of those expectations, their stock prices will fall dramatically. I have seen this pattern before in the dot-com bubble. There were companies with real technology and real products that were simply overvalued. Cisco had real products that real customers needed. But at its peak, Cisco was valued as if it would grow at extraordinary rates forever. When growth slowed to merely excellent rather than extraordinary, the stock fell 80% and took over 20 years to recover. The technology was real, the business was real, but the valuation was built on expectations that could never be met. The same thing happened with many legitimate companies in the 2008 crisis, in the cryptocurrency crash, in every bubble I have witnessed. Good companies with bad valuations can destroy investor wealth just as effectively as bad companies. The key is recognizing when expectations have become untethered from reality. And that is what I see happening in certain AI stocks right now. The first category of AI stocks you should get out of is pure play AI software companies trading at more than 50 times revenue with no path to profitability. I want you to really think about what a 50 times revenue multiple means. It means that if the company converted every single dollar of revenue directly into profit, which is mathematically impossible, because every company has costs, and if you required a mere 2% annual return on your investment, which is below the rate of inflation and far below what any rational investor would demand, it would take 50 years to earn back your investment. 50 years. That is not investing. That is speculation dressed up in financial language and wrapped in impressive-sounding growth projections. These companies typically have impressive technology demonstrations. They can show you AI doing remarkable things on stage at conferences. Their demos generate excitement and media coverage. Their growth rates are extraordinary, often 100% or 200% year over year, because they are starting from a small base where every new customer dramatically moves the needle. Their customer lists include recognizable names, Fortune 500 companies that lend credibility to the technology. All of this creates a narrative that justifies the valuation in the minds of true believers. The story is compelling. The technology seems magical. The future seems inevitable. But the fundamentals do not support the prices. Here is what I have learned about software businesses over 30 years of building technology companies and watching thousands of others succeed and fail. The best software companies in history, the absolute best, the ones that dominated their markets and generated wealth for generations of investors, achieve operating margins of around 40% at maturity. Microsoft at its peak, Adobe in its best years, the very best of the best. Most software companies achieve much less, often 20 or 25% operating margins, and many never achieve positive operating margins at all. Software companies face competition that compresses margins over time. As new entrants chase attractive markets, they face customer demands for lower prices and better terms as purchasing power consolidates. They face the constant need to invest in new products to stay relevant as technology evolves. They face employee demands for higher compensation as talent markets tighten. The idea that a software company will achieve the margins necessary to justify a 50 times revenue multiple is almost always a fantasy held by people who have never actually run a software company through a full market cycle. I have talked to the executives at some of these companies privately. They are smart people. They know their valuations are stretched. They are as surprised as anyone that investors are willing to pay these prices, but they are not going to tell you to sell their stock. That is not their job. Their job is to build their companies. My job today is to give you the perspective that they cannot give you. Look at your portfolio. If you own AI software companies trading at 50 times revenue or more, ask yourself what has to happen for that investment to work out. The company needs to grow revenue dramatically for years. It needs to achieve margins that few software companies ever achieve. It needs to fend off competition from much larger, much better funded competitors who are entering the AI space aggressively. It needs everything to go right. And if anything goes wrong, if growth slows, if margins disappoint, if competition intensifies, the stock will fall dramatically from these levels. The second category of AI stocks you should get out of is hardware companies that have pivoted to AI without the technology to compete. Over the past 2 years, I have watched dozens of companies add AI to their investor presentations, their press releases, their earnings call scripts. Companies that were struggling in their core businesses, companies with declining revenue and shrinking margins and pessimistic outlooks, suddenly discovered that they were AI companies all along. They just needed to rebrand, to reframe their narrative, to emphasize the AI angle that had supposedly always been central to their strategy. Their stock prices jumped as investors bought the story without examining the substance behind it. Here is the reality of AI hardware that these pivot companies do not want you to understand. It is extraordinarily difficult to build competitive AI chips. The barriers to entry are not just high. They are nearly insurmountable for companies starting from scratch or pivoting from unrelated businesses. My company has spent over 30 years and tens of billions of dollars developing our architecture. We started working on parallel computing when most people in the industry thought it was a dead end. We persisted through years of skepticism and multiple near-death experiences. We have thousands of engineers with deep expertise in parallel computing, people who have spent their entire careers understanding how to make these systems work efficiently. We have a software ecosystem called CUDA that took nearly 2 decades to build. Millions of developers have learned to program using our tools. Thousands of applications have been optimized for our architecture. This ecosystem creates enormous switching costs that protect our market position. We have manufacturing relationships with the world's leading foundries that took years to establish and require massive capital commitments to maintain. The idea that a company can pivot into this market and compete effectively within a few quarters is almost always wrong. It reflects a fundamental misunderstanding of how difficult this technology is to build. I have examined the products from many of these pivot companies, sometimes in detail when they approach us about partnerships or when customers ask us to evaluate alternatives. In most cases, their AI offerings are mediocre at best. They are taking existing chip architectures designed for other purposes, perhaps graphics or networking or general purpose computing, and marketing them as AI solutions. The chips can run AI workloads technically in the same sense that you can technically drive a nail with a screwdriver, but they are years behind the leading edge in performance. They lack the software ecosystem that makes hardware useful in real-world deployments. They are competing against companies with massive advantages in technology, scale, and customer relationships built over decades. Some of these pivot companies will find niches where they can compete. There are specialized applications where general-purpose AI chips are overkill in purpose. Built solutions make sense, but the valuations of many pivot companies assume they will compete successfully in the mainstream AI market against entrenched leaders. That is not going to happen. When investors realize this, when the promised AI revenue fails to materialize, these stocks will fall back to valuations that reflect their actual competitive position. Look at the hardware companies in your portfolio that have recently emphasized AI. Ask yourself what their AI products actually are. Ask whether those products can compete against the best offerings in the market. Ask whether the company has the engineering talent, the software ecosystem, the manufacturing capabilities to succeed in AI hardware. If the answers are not convincing, the AI story is probably hype, and you should consider selling before the market reaches the same conclusion. The third category of AI stocks you should get out of is AI application companies in commoditizing markets. This is perhaps the most dangerous category because the companies often have real products and real customers and real revenue. They are not frauds perpetrating elaborate schemes. They are not pivots desperately rebranding failing businesses. They are genuine AI businesses built by talented teams who have created technology that works and that customers value. But they are building in markets that are rapidly commoditizing, which means their current advantages will erode and their margins will compress regardless of how good their technology is today. Let me explain what I mean by commoditization in AI, because this concept is crucial to understanding why certain seemingly successful AI companies will ultimately disappoint their investors. When a new AI capability emerges, the first companies to offer it can charge premium prices. Customers have no alternatives. The technology seems magical, almost miraculous. Willingness to pay is extremely high because the capability solves problems that previously seemed unsolvable. Early customers are often delighted to pay whatever is asked, but AI capabilities spread quickly in ways that other technologies do not. The research underlying most AI breakthroughs is published openly. Academic papers describe the techniques in detail. Open source implementations become available within months, sometimes within weeks. Large platform companies have research teams that can replicate and improve upon published techniques rapidly. They add similar features to their existing products that already have hundreds of millions of users and established distribution channels and trusted brand names. Competitors emerge with comparable offerings built on the same underlying research. Within months or years, sometimes within just weeks, what was once a unique capability commanding premium prices becomes a commodity available from many sources at much lower prices. The standalone AI company that pioneered the capability finds itself competing against free or nearly free alternatives, bundled with products customers already use and trust. Growth stalls as the easily addressable market gets saturated. margins compress as competition intensifies. The stock collapses as investors realize the company cannot sustain the growth rates that justified its valuation. I have watched this pattern play out repeatedly in the AI market over the past several years. A company builds an impressive AI application. It solves a real problem. Customers love it. Revenue grows rapidly. The stock price soars. Analysts write glowing reports about the total addressable market. Then the large platform companies notice the opportunity and add similar capabilities to products that already have hundreds of millions of users who pay nothing extra for the new features. Suddenly, the standalone AI application is competing against alternatives that are free or bundled or deeply integrated into workflows customers already depend upon. The competitive dynamics shift dramatically and permanently. The companies most vulnerable to this dynamic are the ones building AI applications on top of foundation models they do not control. They are essentially building features on someone else's platform. When the platform provider decides to offer similar features directly, the application company's value proposition disappears. This has happened to countless companies building on top of major technology platforms, and it will happen to many AI application companies as well. Look at the AI application companies in your portfolio. Ask yourself whether their capabilities are truly differentiated or whether they are thin wrappers around foundation models that anyone can access. Ask whether large platform companies could easily replicate their features. Ask whether they control their own technology or depend on others. If the answer suggests commoditization risk, consider selling before that risk materializes. The fourth category of AI stocks you should get out of is companies with AI exposure primarily through hype rather than revenue. These are companies that have benefited from the AI narrative without actually generating meaningful AI revenue. They might mention AI frequently in their earnings calls. They might have announced AI partnerships or AI initiatives. Their stock prices might have risen with the AI wave. But when you examine their actual financials, AI is a trivial part of their business. I call these AI adjacent stocks. They are adjacent to the AI boom, but not really participating in it. Their management teams have learned that mentioning AI causes their stock prices to rise, so they mention AI constantly. But the substance behind the mentions is thin. Their AI products are early stage or immaterial. Their AI revenue is a rounding error. Their AI strategy is more aspiration than reality. The danger with these stocks is that they have been bid up by investors who heard AI and bought without examining the details. When those investors eventually look more closely, when they realize that the AI story is mostly marketing, they will sell. And because the stocks rose on hype rather than fundamentals, they will fall back to levels that reflect their actual businesses, which may be significantly lower. I have seen management teams become remarkably creative in finding ways to mention AI. Companies that have nothing to do with AI are discovering AI angles. It's in their businesses. Various storage companies are now AI infrastructure companies. Networking companies are now AI connectivity companies. Even consumer products companies are finding ways to work AI into their narratives. Some of these connections are legitimate. Many are stretched to the point of absurdity. Look at the companies in your portfolio that have benefited from AI enthusiasm. Examine their actual AI revenue. Read their financial statements carefully, not just the headlines and press releases. If AI is less than 10% of their business and not growing rapidly toward a larger share, the AI premium in their stock price is probably unjustified. Consider selling before other investors reach the same conclusion. The fifth category of AI stocks you should get out of is speculative AI companies that have never generated positive cash flow and have no clear path to doing so. These are the most dangerous AI investments because they combine all of the risks I have described with the additional risk of running out of money before they can prove their business model. In every technology boom, speculative companies attract enormous investment. Their stories are compelling. Their technology demonstrations are impressive. Their visions of the future are exciting. Investors imagine the potential and pay prices that assume that potential will be fully realized. But most speculative companies fail. They run out of money. They get outcompeted. They discover that their technology does not work as well as hoped, or that customers do not want it as much as expected, or that the market develops differently than planned. The AI boom has attracted hundreds of speculative companies. Some of them will succeed spectacularly. A few might become dominant players that define the industry for decades, but most will fail. That is simply the math of speculative investing. Most speculative bets lose money. The winners have to be big enough to compensate for all the losers. And in a market where speculative AI stocks are priced for perfection, even the winners may not deliver the returns that their current prices imply. I worry particularly about speculative AI companies that went public during the boom of 2020 and 2021, when investor appetite for growth stories was insatiable. Many of these companies raised money at valuations that assumed years of hypergrowth and eventual profitability. Now they are discovering that hypergrowth is hard to sustain, that profitability is elusive, and that the public markets are less forgiving than the private markets they left. Look at the speculative AI stocks in your portfolio. Ask yourself whether they have ever generated positive free cash flow. Ask how much cash they are burning each quarter. Ask how long their current cash will last if they cannot raise more money. Ask what has to happen for them to reach profitability. If the answers are concerning, if the path to profitability is unclear, if the cash runway is limited, consider selling before a capital crisis forces the company to dilute shareholders dramatically or shut down entirely. Now, let me address the obvious objection to everything I have just said. If AI is going to transform the world, if it is the most important technology since electricity, if it will create trillions of dollars in value, should you not just hold AI stocks through any volatility? Will the long-term gains not compensate for any short-term losses? The answer is that it depends on what you own and what you paid for it. High-quality AI companies purchased at reasonable valuations will likely deliver excellent long-term returns even if they experience significant volatility along the way. But low-quality AI companies purchased at inflated valuations may never recover, no matter how transformative AI becomes. The dot-com crash taught us this lesson. The internet transformed the world, exactly as the boosters predicted. But many internet stocks from 1999 never recovered. The investors who bought Pets.com or Webvan or countless other dot-com stars lost everything, despite being right about the importance of the internet. The AI transformation is real. I believe in it completely. I have dedicated my career to building it. But believing in AI does not mean believing in every AI stock at any price. Discipline still matters. Valuation still matters. Quality still matters. And right now, in certain corners of the AI market, discipline and valuation and quality have been abandoned in favor of pure speculation. Let me share some specific warning signs that a stock in your portfolio might fall into one of these dangerous categories. These are the red flags I look for when evaluating AI investments, and they should guide your analysis as well. First, look at the valuation relative to current financials. If the market capitalization is more than 50 times revenue, you need an extraordinary story to justify that price, a story that requires everything to go right for many years. If there is no revenue at all, if the company is pre-revenue and valued at billions of dollars, you are speculating on hope and narrative, not investing in a business that might work out. Some speculative bets pay off enormously, but understand what you are doing and size your position accordingly. Second, look at the competitive position. Is the company a leader with sustainable advantages that will persist as the market matures, or is it a follower hoping to catch up to better funded and better positioned competitors? Does the company have proprietary technology, or is it building on open source foundations that anyone can access? Does the company have distribution advantages, or is it dependent on expensive customer acquisition that will become more expensive as competition intensifies? Third, look at the path to profitability. Can you construct a realistic scenario where the company generates significant free cash flow within a reasonable time frame? What margins would be required? What market share would be required? Are those margins and that market share actually achievable given the competitive dynamics of the industry, or does the path to profitability require assumptions that strain credulity forth? Look at the balance sheet. Does the company have enough cash to reach profitability without raising additional capital? If it needs to raise more money, what will happen to your shares? Will you be diluted significantly? What happens if the capital markets become less receptive to AI stories? Could the company face a funding crisis that forces desperate measures? Fifth, look at the management team. Do they have the experience and track record to execute in a competitive market? Have they built successful companies before? Have they navigated challenging periods? Or are they first-time founders who have only known good times and easy funding? If a stock in your portfolio fails multiple tests across these criteria, it is probably in one of the 5 categories I described. If it fails all of them, you should sell immediately without hesitation. The question is not whether these stocks will fall, but when, and you do not want to be holding them when the market finally recognizes what you should have seen all along. Let me also address timing. I said you should get out before the first quarter ends. Why that specific time frame? Because I believe we are approaching a moment of reckoning for AI stocks. The initial wave of AI enthusiasm has pushed valuations to levels that require perfection. Now companies have to deliver results that justify those valuations. Earnings reports in the first quarter will reveal which companies have real AI businesses and which have been riding hype. The companies that disappoint will fall hard because expectations are so elevated. I also see signs that the easy money that fueled AI speculation is becoming less available. Interest rates are higher than they were during the peak of the AI boom. Venture capital is becoming more selective. Public market investors are becoming more discriminating. The environment that allowed speculative AI companies to raise money easily is changing, and that change will expose the companies that depended on continuous capital infusion to survive. Finally, I see competitive dynamics intensifying in ways that will pressure AI companies across the board. The large technology platforms are investing heavily in AI. They have the resources, the talent, the distribution, the customer relationships to dominate many AI markets. Standalone AI companies that have to compete against these giants will find it increasingly difficult to maintain their growth rates and margins. The AI stocks that are priced for continued hypergrowth may struggle to deliver. I want to be clear that I am not predicting a crash in the overall market or even in AI stocks generally. I am saying that certain categories of AI stocks are priced for outcomes that are unlikely to materialize. Those specific stocks will fall significantly regardless of what happens to the broader market. And the time to sell them is before the first quarter earnings reveal the gap between expectations and reality. Some of you might be wondering why I am giving this warning. What do I have to gain by telling you to sell AI stocks? The honest answer is nothing directly. If anything, bearish sentiment about AI stocks could affect my own company, which has benefited enormously from AI enthusiasm. But I have been in this industry long enough to know that sustainable success requires a healthy ecosystem. When investors get destroyed by overhyped AI stocks, they become skeptical of all AI investments. That skepticism makes it harder for legitimate AI companies to raise capital and build their businesses. It slows down the AI transformation that I have dedicated my life to enabling. I would rather have investors make money on high-quality AI investments than lose money on low-quality ones. I would rather have a smaller AI boom that is sustainable than a larger one that collapses and takes years to recover. I would rather see capital flow to companies that are building real products and creating real value than to hype machines that will ultimately disappoint. So consider this warning a contribution to the health of the AI ecosystem. Sell your overhyped AI stocks, reinvest in quality, maintain the discipline that will allow you to participate in the AI transformation for decades to come. That is how you build durable wealth. That is how you avoid becoming a cautionary tale. That is how you benefit from what I believe will be the most important technological transformation of our lifetimes. Let me close with some thoughts on what to do after you sell your overhyped AI stocks. The answer is not to abandon AI investing entirely. AI is real and important and will create enormous value. The answer is to be more selective, to focus on quality, to demand reasonable valuations. Look for AI companies with sustainable competitive advantages. This means proprietary technology that is difficult to replicate. It means strong customer relationships with high switching costs. It means network effects that reinforce market position over time. It means scale advantages that allow efficient operations. Companies with these characteristics can maintain their positions even as competition intensifies. Look for AI companies with clear paths to profitability. This means business models that generate positive unit economics. It means customers who are willing to pay prices that cover costs and generate margins. It means operating leverage that allows profits to grow faster than revenue as the company scales. Companies with these characteristics can become self-sustaining rather than dependent on continuous capital infusion. Look for AI companies with strong balance sheets and financial flexibility. This means enough cash to fund operations through any reasonable downturn without desperate fundraising. It means limited debt that could create problems if growth slows or if interest rates rise. It means the financial flexibility to invest through cycles rather than cutting back when times get tough, to acquire distressed competitors, to fund research and development even when revenue is under pressure. Companies with these characteristics can survive the inevitable volatility of technology markets and emerge stronger on the other side. Look for AI companies trading at reasonable valuations. This does not mean cheap in absolute terms. Great companies rarely trade at cheap prices, but it means valuations that can be justified by realistic projections of future cash flows, not valuations that require everything to go perfectly for decades. It means paying for current quality and reasonable growth, not for dreams and hopes. If you apply these criteria rigorously, you will end up with a smaller portfolio of AI investments. You will miss some big winners because some overhyped stocks will continue to rise before they fall. But you will also avoid the devastating losses that come when hype stocks collapse. Over time, the quality approach will compound your wealth far more reliably than the hype approach. The AI transformation is coming. It will create enormous wealth for investors who participate wisely and who maintain the discipline to distinguish between substance and hype. But it will also destroy wealth for investors who confuse marketing with fundamentals, who pay any price for any company with AI in the name, who abandon the discipline that separates investing from gambling, who let fear of missing out override rational analysis. Do not be one of those investors who becomes a cautionary tale for future generations. Sell your overhyped AI stocks before the reckoning arrives. Focus on quality companies with real competitive advantages and realistic valuations. Maintain the discipline that will allow you to compound wealth over decades rather than losing it in a single correction. And position yourself to benefit from the AI transformation for the rest of your investing life. The choice is yours. The warning has been given. The patterns have been explained. The categories have been identified. What you do with this information is entirely up to you. But do not say you were not warned when the overhyped stocks in your portfolio collapse and the investors who maintain discipline are left to pick up quality assets at discounted prices.